Have you ever wondered what happens when a green revolution smacks right into a geopolitical trade war? Well, today we're going to dive into the story of one company, Zhongxin Packaging, that found itself at that exact messy intersection and what it did to fight its way out. So, the world is pretty much banning single-use plastics, right? And that's creating this absolute gold rush for sustainable alternatives. The market for what's called pulp-molded packaging, those compostable takeout containers, is already a massive multi-billion-dollar industry. But honestly, what's really staggering is the forecast. We're looking at some seriously exponential growth over the next decade. This isn't just a trend, it's a huge global economic shift. So, who's actually making all this stuff? Well, turns out, behind many of the world's biggest food service and packaging brands is a company you've probably never even heard of, Zhongxin Packaging. They are the engine here, the upstream manufacturer, turning agricultural waste into all those eco-friendly products that are now, well, everywhere. And they do it with this really fascinating process called molded fiber technology. The simplest way to think about it is kind of like high-tech papier-mâché. They take leftovers from farming, mostly sugarcane fiber, mix it all into a pulp, and then use a ton of heat and pressure to mold it into really strong, durable packaging. The kind that can hold hot soup, fried food, you name it, and then completely compost when you're done. But just as Zhongxin was riding this incredible green wave, it slammed headfirst into a geopolitical tsunami, a massive tariff wall that threatened to completely cut it off from its single most important market. The first blow was an anti-dumping tariff from the United States. And the number, it's just breathtaking, 283.89%. Let's be perfectly clear about this. A tariff this high isn't just a tax to raise a little revenue. No way. It's a wall. It's a blockade. And it's specifically designed to make a product completely uncompetitive. And it didn't even stop there. On top of that came a second punch, a nearly 98% anti-subsidy tariff. So when you combine these double remedies, what you get is a financial barrier so high it's pretty much insurmountable. It made shipping their core products from China to the US not just expensive, but economically impossible. And as the company itself put it, these tariffs forced a complete reorganization of their entire global supply chain. Their whole business model, which relied on exporting from China, was basically broken overnight. So what do? This is where the story gets really, really interesting. Instead of retreating, Zhongxin executed this massive, calculated pivot to build, essentially, a tariff-proof bridge back to its biggest customers. The strategy was a pretty fundamental shift in their identity. They had to go from being a China-centric exporter to becoming a truly globalized local manufacturer. The goal was no longer just to make things in China, but to make things for their target markets, in or at least near those markets. Their solution was this nimble, three-pronged China plus one strategy. First, build a massive new production hub in Southeast Asia to serve international clients, which neatly sidesteps the tariffs. Second, do the totally unexpected, onshore production by building a factory right inside the United States. And third, diversify their product line so they're less reliant on the specific items getting hammered by tariffs. And listen, this wasn't just some plan on a whiteboard. They put serious capital behind it. A total of $130 million was poured into a state-of-the-art facility in Thailand. Another $36 million was earmarked to build a brand new factory in Pennsylvania. And to fund all this, they deliberately hit the brakes on major domestic projects in China, redirecting that cash to where it was needed most. And here's the really savvy part of their product diversification. For less than $1 million, they bought a small company that gave them the tech to get into the high-margin boutique industrial packaging market. This means creating these custom molded fiber inserts for things like consumer electronics, cosmetics, a completely different product category, and one totally immune to the tariffs hitting their tableware. Super clever. Okay, but a pivot this massive and this fast, it doesn't come for free. So what did this all cost? Let's take a look at the financials to really see the price of building this new resilient supply chain. The very first number that just jumps off the page is the hit to the bottom line. Net profit dropped by nearly 18%. Now, this isn't surprising at all. It reflects the immense short-term costs of building new factories, shifting production lines, and just reorganizing a global operation on the fly. This is the upfront price you pay for resilience. But, and this is a huge but, here's the crucial counterpoint. While net profit was down, their operating cash flow, that's the cash generated from the company's normal day-to-day business before all those big investments, it surged by over 30%.
This is such a vital metric. It shows that the core business was actually really healthy and profitable. Despite all the chaos and big spending, they were managing their money with extreme discipline, strategically plowing it back into the future.
And this data, right here, it clarifies the whole story perfectly. You see those dips in overall revenue and production volume? Well, those weren't signs of a failing business or a lack of demand. Nope. They were the direct, totally expected results of deliberately winding down production in China while that new Thai factory was still ramping up to take over the orders. This is basically the statistical signature of a supply chain in mid-flight. So let's just zoom out for a second. This isn't just a story about one company's survival. It's really a potential blueprint for the future of global manufacturing in an increasingly fractured world. Zhongxin's pivot is just a masterclass in strategic agility. For decades, the dominant logic in manufacturing was always centralization, right? Find the single most efficient place in the world to make something and just scale up. This story really challenges that old model. It suggests that in an era of geopolitical risk, true resilience isn't just about efficiency anymore. It's about redundancy. It's about decentralization. It's about building a flexible network that can absorb shocks, even if it comes at a higher short-term cost. And that kind of leaves us with a final thought. We always think of innovation in terms of flashy new products. But in an age of tariffs and trade walls, maybe the most important, most innovative technology a company can build isn't a product at all, but a truly resilient supply chain.